All right, hello again. So here we are for module 3. Module 3 has lessons 4 and 5 in it. So we're just going to go ahead and get started. Lesson 4 is on loans. So we're just going to start with some of the basic information about loans. So first thing to know is that with a loan, you'll have an interest rate. So that is what you pay the lender as a fee for borrowing their money. So that could be, someone like your credit union, a bank, whoever you're borrowing the money from, the credit card company. And it's basically just a fee you pay for using their money, right, until you pay it back. So it can be fixed or adjustable. So over the term of the loan, it can stay the same percentage. It can adjust sometimes, and they'll tell you that when you get the loan, they'll tell you if it's fixed or adjustable. And then the last thing is it's often based on your credit history. So most of the time, they'll pull your credit history. They will look at that and just kind of determine the interest rate off of that. So if you have a good credit history, a good credit score, often your rate will be lower. If you have a not so good credit history or credit score, it could be higher. And we talked about that a little bit in module 2 about why that is, right? Next thing is secured versus unsecured loans. So a secured loan is a type of loan that has some sort of collateral that can be seized if you aren't paying on it. So that would be like a car loan, a home loan, a mortgage. And that means if you stop paying, they can come take that from you. So they can foreclose your home, they can repossess your car, things like that. An unsecured loan is the opposite of that. So there isn't any collateral. That often means that you're paying a higher interest rate. And sometimes they can require a cosigner. So somebody else to sign saying that if you don't pay, that they will, right? And that would be something like a credit card. If you don't pay your credit card, they're not going to come take your car from you because they don't have that collateral. And that's part of the reason credit card interest rates are so high. Okay, we're just going to jump right in. We're going to go over all the different types of loans. So we have home loans. It's called a mortgage. It's just the type of loan used to buy a home. There's an FHA loan, which you can get that with a small down payment. They require a 3.5% down payment and a low credit score of 580. So the reason that they can do this is they're backed by the Federal Housing Administration. It will reimburse lenders if you default. So it reduces the risk for the people that are giving you the money, which is why they can take people with lower credit scores, lower down payments, things like that. Next one, you just have a conventional loan. It's not backed by the government. Usually they require 3 to 20% down payment. It requires private mortgage insurance if your down payment is under 20%, which means that you basically are paying insurance to protect the lender if you default on your loan. So that adds to your monthly cost of the loan. We have USDA loans, which are for rural areas. So I think places like Eagle Mountain here can qualify for USDA loans, but your income can't exceed the 115% of the area's kind of average income. You can put 0% down, and there are guarantee fees that can be required and sometimes can cost less than private mortgage insurance, which is on a conventional loan. So they can be a good option sometimes. Usually the people that are helping you get home loans can walk you through these options. And then we have VA loans. So that's for active duty military and veterans. 0% down, no private mortgage insurance, which can be really awesome if you've served in the military. And they're backed by the Department of Veterans Affairs, which is why they can do that, right? Okay. So we have kind of the what makes up a mortgage. So we have the principal. So when you're making your payment every month, you are paying towards all of these things. So your principal, that is the money that goes directly towards the loan balance. So you're paying a chunk of that every single month toward your loan balance. Every single month you're paying interest. So you're paying that basically to the bank. It's all lumped into one payment, but part of it is the principal, part of it is the interest. And then we have taxes and insurance. Usually the lender will keep this money in what's called an escrow account and pay property taxes and home insurance through that. So that's usually lumped in with your monthly payment on a mortgage as well. Usually for mortgages, the term is 15 or 30 years. Those are the most common ones. I would say 30-year loans are the most common. A 30-year loan will have a lower monthly payment. A 15-year loan will have larger payments, but you save on interest since you're paying it off faster. You're not borrowing the money for as long. So that's kind of the basics. Especially with homes, it can get kind of confusing, and I don't want to get too into the weeds, but if you have questions about that, you can always email me, reach out. Or if you're in the process of doing that, you can talk to your loan officer and they can help walk you through kind of the pros and cons of each one. But that's just kind of the basic information. So the next one is car loans. So they have the same basic principles as the home loan. So you pay your interest, you pay your principal. So an interest is what you pay the bank or credit union or whoever for borrowing the money, right? A car loan term is usually 3 to 5 years. I would say 5 years is definitely the most common, but it could, 3, 4, 5 years. Sometimes they go to 6. Usually it's 5. So usually you'll put a down payment on a car as well. So that's just kind of money up front, whether that's like $1,000, $2,000, or a couple hundred. So the more you pay upfront, the smaller your monthly payment is, and the less interest you're owed in total because you're borrowing less total, right? There's a lot of really awesome tools online that you can use to estimate your payment to see what you can afford. So, if you can pay $500 down, you have an interest rate of 5%, it will calculate what your monthly payment would be. And that way is a good way to know kind of how much you can afford if you're looking to buy a car. Okay, next is student loans. So these can get pretty complicated. We're not going to get super into it, but there are a couple different kinds. So there's direct subsidized loans, and those are for people getting their undergraduate degree, and they have to show financial need. So if you're getting a bachelor's degree or lower, you can qualify for these, and you have to fill out the FAFSA form and demonstrate that you need the loan, right? They usually have really low interest rates. They have awesome flexible repayment options, and the federal government pays the interest while you're in school. So you don't owe any interest for the time that you're in school, which can be really, really helpful. The next one is direct unsubsidized loans. So these can be used by undergraduates, graduates, and if you're getting a different type of degree. They're also pretty good options. They have low interest rates, also flexible repayment options, except for you are responsible for all the interest. So you will still be responsible for paying the interest while you're in school. And that's the main difference between direct subsidized and direct unsubsidized. Subsidized means that the government is paying the interest for you while you're in school, which is really awesome. Those are probably the best kinds of student loans to get if you can. The next one is called a direct plus loan. That is for graduate and professional degree students and also parents of dependent undergraduate students. So if you have a child in school, you could get this type of loan, but they do require that you have like a good credit history. They're more like a traditional loan. Direct loans have a grace period. There's a typo there. It's called grace period, usually 6 months after graduating, leaving school, or dropping below half-time enrollment when you don't have to make payments. So you usually will have 6 months after you graduate or you leave school, right, where you don't have to make payments, and payments will begin to be due about 6 months after you've finished school. Standard repayment takes 10 years for student loans. Now that can change based, if you're going based on your income and your payments are lower than what standard repayment says, it can take longer, but 30 years is the max that they allow. So once you graduate, you can always talk to your loan, the people who are giving you your loan, and they can help you figure out repayment options if that's something you're looking for. But student loans can be a great resource, but they can be confusing. So again, if you have questions, feel free to reach out. And now this next one is very important. So we have title loans and payday loans. So we want to avoid those as much as possible. These are the types of things that you'll see just kind of like in strip malls on the road. And they'll, offer that they can like give you an advance on your paycheck or something. So they are very predatory. The interest rates that they charge are really, really big. 391% is the average. So that's really high. They can be higher than 600%. These are things that we want to avoid at all costs if we can, right? If it's the last resort, sometimes you do what you have to do, but we want to avoid that at all costs. Usually the premise for this is that they'll say, oh, we can give it to you ahead of time, or we can give you money for your car title. You have 2 weeks to pay it back. And then that's when we start charging interest. And 80% of these loans do not get paid back within the 2 weeks. And that's when the interest rate starts to continually go up. And it just kind of ends up being a continual thing that people have to continue borrowing, and it's really hard to get out of. So these you want to avoid as much as possible. So yeah, they're very predatory. So that is actually the end of our slideshow. I said we have lessons 5 and 6, but we actually, or 4 and 5, but we actually just have lesson 4 in this one. So go ahead and come back, and we'll see you for the next one.